I have the pleasure of welcoming everyone to this latest ASA live webinar. This very important time of worldwide recession caused by coronavirus, when companies need funding than ever. Policy responses from governments, central banks, and DFIs, development finance institutions, are opening up new funding sources. But at the same time, we also see stimulus by central banks driving interest costs even lower. So the big question is, how can companies tap into this stream of funding? In this webinar with our expert panelists, we'll be unraveling changes in development financing and exploring the best ways to approach public, private, and what we call blended finance sources. My name is Boason Omofaye. I'm a senior consultant at New Markets Media and Intelligence, and I sit as a financial journalist here in Lagos, Nigeria. At a new media consultant, we work with researchers, media, governments, and businesses, helping them to understand their business activities in frontier and emerging markets. Our host for the webinar today is ASA. As some of our participants may know, ASA is Africa's leading non-bank currency broker, which stands at dedicated to keep funding flowing into Africa. So we understand what ASA is doing. Thank you very much, ASA, for putting this seminar together again, this webinar, and I appreciate being part of it. Now, I have three individuals who were qualified to discuss today's topic, and let me start with Suresh Samuel, who is an investment director at Bankable. It's good to see you, Suresh. Suresh has worked as a provider of, Lendable is a provider of growth debt to financial technology companies working in emerging and frontier markets globally. Suresh has spent some time as the managing director for Africa at the Overseas Private Investment Corporation, known as OPIC as an acronym. Suresh has executed over $1 billion in transactions in Africa, Latin America, Asia, Eastern Europe, and is based in Nairobi, Kenya. But he's joining us today from the United States, by the way. It's good to see you, Suresh.
Yeah, thanks for having me. Happy to be here.
Welcome to the program. And let me introduce Linda Habgood, the CEO of Delphos International, also a former investment and colleague to Suresh at OPIC. It's good to see you, Linda.
Nice to see you too, Raj.
Thank you so much. Then let's talk about Adam. Of course, Adam Gouveia, the Chief Financial Officer at ASA. It's good to see you, Adam. Adam has worked as a hedge fund officer at the height of the financial crisis in 2008, 2009. Adam says he's learned more in 4 months than he did in 4 years prior to that period in his professional career. And if you want to know more about crypto and blockchain, knock on the door of Adam. He's the man there who work with companies then at Pantera Capital. It's good to see you also, Adam.
Yeah, Boason, good to see you, and looking forward to discussing this topic with everybody.
Thank you so much. A very important time for us to have conversations of this nature put together by ISA. We look forward to our participants who will look forward to answer all the questions which were sent in advance to our team. From our very significant participant group on today's call, we advise everyone to post any further questions and share your thoughts, your opinions, your anecdotes, whatever, using the Q&A function button. We'll do our best to address those questions within the period of this webinar. And please be aware we have journalists who are also on this webinar, so we're recording these broadcasts. So let me get our three panelists started with the question, what you do and how much of what you do have changed since the global outbreak of COVID-19. If you give us that in about 2 minutes, that will be really good. I'm going to be gender sensitive, so I'm going to go straight to Linda.
Thank you very much, Boason. And good morning and good afternoon to everyone. Delphos International, the firm that I head, is a financial advisory firm with a global presence and a focus on emerging markets, helping our clients to primarily access the development finance institution and export credit agency monies around the world to help them progress their businesses. Since the start of COVID, our business has really not changed a lot, except that we need to do it from different platforms. And if anything, it's accelerated in the face of a lot of new programs being established and new monies coming into the markets from the development finance institutions.
Interesting. Let's hear from Suresh.
Yeah, sure. So at Lendable, as mentioned, we focus on supporting kind of access to increased financial services really through the financial technology community throughout emerging markets. And heading into COVID, or as COVID was beginning to ramp up, we took a very deliberate approach in what the impact was going to be. So thinking about it from a sector perspective, so what of our subsectors, what was our thesis around how they would be impacted by COVID? And the impact has been quite wide ranging, with some struggling as you would expect, and others really accelerating their business as there's been a shift to digital, particularly in the financial services sector. We also looked at it on a country basis, right? The impact in Nigeria, where you sit, is very different than it has been in Kenya or in Indonesia and the Philippines, for that matter. And so we kind of looked at it from a country perspective and said, okay, where can we try to transact in this time? But then, of course, just the execution became much more difficult, right? So we typically always want to do on-site due diligence. We realized very quickly that that was not going to be possible. So we adjusted our policies to say, okay, we can do everything desktop, but we have to have enhanced procedures around that. And I think a lot of the investment community ended up going this way, some faster than others, but it enables us to transact throughout this time. And we've been actually quite busy throughout this time. But we've seen the overall ecosystem, progress over the months of COVID, where everything kind of stopped in the first few months and they're starting to move again. But I think there has been overall additional friction to the process. So deal cycles are definitely taking longer, both for us just incrementally, but then I think in the wider investment community, particularly on the debt side.
Thank you, Suresh. Adam, we know what you do, but the key question is, what has changed since COVID-19 outbreak in March? It's been about 7 months down the line.
We provide digital payments for customers, and so from a customer perspective and a volume perspective, nothing's changed. We don't actually even have physical branches. You can't walk into a store. So from a customer perspective and from a transaction perspective, it's really accelerated because people have really moved into a more digital channel. So that's been great for us. And from a company perspective, from an operating perspective, we've always had a distributed model where we've had multiple offices. We've always worked over Zoom, video calls, Slack, these kinds of remote communication devices. And so it really wasn't a big change for us. I think we were very lucky to be in a good position where essentially overnight we could be up and running remotely, notwithstanding, people have to deal with different schedules and things like that and working from home. But we really have, I would say, accelerated through the whole COVID issues, since when we started working from home in March, really. And we actually, probably the rest of the year, will continue to work from home.
Interesting how times have changed and how all of you are coping with the new way of doing things, especially going digital technology and what have you, in particular in sub-Saharan Africa. So let me ask Linda very quickly, are private sector lenders risk averse because of the coronavirus, or they're eager lenders because they see rates at a very low level at this point in time?
So I think what we're seeing in the markets now is fairly expected from the private sector lending institutions. When the markets are uncertain or there's higher levels of risk, you see hesitancy from those institutions. What is helping to keep money flowing into the markets now is the additional capital that has been committed by the multilateral lenders and the bilateral lenders. Often what's happening now, in order to get capital more quickly to the end user, is that the DFIs are providing large amounts of capital to the financial intermediaries in sub-Saharan Africa, in Asia, in Latin America, in the emerging economies, where some of that local financing that they would typically rely on is becoming less and less available. And so we're hoping that that trend continues. If you look at the commitments that the DFIs have made over the last quarter, they've been very significant. The commitments to continue to process new loans are also very admirable. And so we're hoping that that capital that is now finding its way, into the markets through commitments and disbursements is going to trickle down to the places that it really needs to be. Because I do think that we will continue to need to rely on institutions like Lendable and ASA to make sure that that capital, at the wholesale level actually gets down to help, at the consumer level.
Thank you, Linda. Suresh, in terms of still speaking to the same question about risk and return, when you look at Africa, do you think private sector lenders are holding their fingers a little bit off the lending button because of the pandemic? Are they scared about it when they see the number of fatalities and infections? Or they say, look, interest rate is very low. We can do some of what Linda just spoke about.
Yeah, I think those lenders like Lendable who are active, pre-COVID in Africa and active during COVID, we certainly are taking a more, conservative view into how we're underwriting transactions and the positioning of a company during COVID and being able to withstand a longer, downturn before, markets return to normal and business return to normal. That said, I think it is very country and sector specific, right? So the impacts are kind of across the board. When we talk about, is it driving, because yields in developed markets particularly are low, is it driving more interest into Africa debt? I would actually say no. I think there's also been a dislocation in more higher yielding stuff in the US and Europe. And so those investors have still had things to invest into in those markets. So it hasn't had them explore new markets at this point. But those who are active, pre-COVID continue to be active, but perhaps just trying to find borrowers who are better positioned, better capitalized in business lines that are doing better. So we've certainly been active. I would say we've seen other lenders active, but it's been in more recent months. So they've, perhaps taken time off the out of the market in new deals and really focused on existing portfolio, but have started to come back, and we're seeing them, look at deals on a more frequent basis now.
Okay, so we're talking about lenders. Now let's talk about the companies that need funding. So I'm going to ask Adam, what do you think companies need to do to be aware or to be successful in raising funds at this particular point in time?
Well, I think at this point in time, you really need to leverage the existing relationships that you've had with the existing investors. If you think about, if you look at some of the data sources and some of the deals that have been done, you look at PitchBook, since April, there have been a lot of transactions, VC, private sector, public sector, that have closed, since we've been in this pandemic. I think the question is that were those relationships developed prior to the pandemic? Were they developed during the pandemic over Zoom? So I think that if you're in a position to raise, you really need to leverage existing networks, leverage your existing investors, leverage, talk to anybody who actually will will look at it, whether that's the rich uncle or whether that's a VC or a public institution, or whether you're lucky enough to be in a place where there are debt forgiveness programs from the government or various lines that you can tap into. And the other thing is that I think you really have to have a plan or really address the COVID issue and speak specifically to what your business is going to be able to do during COVID and how it's going to either come out thriving or stronger, or how you're going to address and mitigate some of the risks that you've been up against.
Interesting. Linda, what are you learning from companies, how they're positioning to their replanning, like Adam says? What else do they need to do differently to be able to attract funding?
So what we're seeing does differ sector to sector. As we all know, some sectors around the world have been a lot more affected immediately by the pandemic. So the hospitality sector clearly is struggling and thinking a lot about how they will present to customers over time in a different way that is, more sensitive to social distancing and, not being in spaces with a lot of other people. So, but in a lot of other sectors that we're working in, we provide a lot of support to portfolio companies and private equity groups. We're involved in a lot of infrastructure projects, and we're so in telecom and power and oil and gas. Honestly, as we talk to our customers, most of them, in the uncertainty that's in the world right now, see a lot of opportunity. And so not everyone has figured out yet exactly what it is that they want to take forward in terms of a specific transaction. But we're seeing a lot of activity, a lot of people trying to get themselves aligned to take advantage of the opportunities in the market. And I'll just amplify something that Suresh said about the activity that happened early in the markets since the start of the pandemic. I agree that a lot of institutions initially were providing capital to their existing borrowers or their existing investee companies to help shore them up and help them recover from some of the impacts of the pandemic. And then we have seen a lot of capital flowing onto platforms that are looking for higher yield opportunities. So risk obviously introduces interest in higher returns, and we're definitely seeing a lot of people out there looking for those struggling businesses that may be willing to pay more for capital to get through this time. But generally, a lot of interest in not sitting on the sideline, but getting into the game, and looking at how they can grow their businesses either on a vertically integrated basis, or even looking to expand into new countries.
Interesting. As we continue this conversation, let's get to talk about one very big point. And I'm asking Suresh if public sector funding or partnership opportunities are decreasing because governments across Africa and around the world have other spending priorities, or they are becoming or increasing these funding necessities because they need private sector help. What are you learning across the sub-Saharan Africa, for example?
So I'd say generally what we're seeing, what I'm seeing is that's not the case. We are continuing to see that public sector funding continue through, right? There's new allocations to the health sector to help countries combat, the pandemic. But we're continuing to see them active on transactions specifically. But that said, these public agencies tend to have very long transaction cycles. So these are possibly transactions that were started well before COVID hit. If they're picking up conversations now, they're deals that will be closed a long time from now. I don't know that I've seen anything that's actually been originated and closed by a public sector institution, within the last, 5 or 6 months. That said, we do see the appetite is still there. So they very much, I think when you look at the public sector organizations, their investment arms are a separate arm, right? And those investment arms still have a mandate, and their mandate now is even enhanced, right, to help, economies recover through the private sector. And so they have enhanced missions during COVID to really support that network. That said, their cycles just take time, right? And I'm specifically speaking about debt. I think the equity cycle can move faster, and we have seen a lot of equity investments just in emerging markets globally during the last couple of quarters. But from a debt perspective, particularly in Africa, it's continued to go slow. Also, we've noticed that a lot of the DFIs were very slow to remove the requirements for on-site due diligence. And that just hasn't been a reality in the last 5 or 6 months when everyone's been working from home. And so they're now moving in that way, but it's been a slow movement, and that's definitely slowed down transactions as well.
So when we see developments such as yesterday when Egypt floated $750 million in sovereign green bond at 5.75 yield, and Morocco doing a $1 billion Euro bond, is that opening the door just or looking through the window, see what goes on outside there?
Yeah, so I'd actually say, so I was really commenting on private sector financing in terms of into businesses. When you look at sovereign raising of capital, we've seen a lot of activity. Egypt's been a great example. So they reached to the IMF, but they've also reached to the private markets for bond issuance. And they've continued to issue more and more capital to help shore up their own capital base in the country and really respond to the needs of the country. But we've seen that replicated in you know, with IMF lines in Kenya, Uganda, South Africa, you know, West Africa, in multiple countries there. So we have seen a lot of sovereign level debt financing being raised during this time, both from public sector institutions, but also the private markets as well on select occasions. And Egypt's a great example of that.
Let me ask a straight question from Adam. Have sources of financing, have they opened up, generally speaking?
I think that they've, as both Linda and Suresh have commented on, they've started to open up more and started to have more conversations with investors, let's say post April and May, as Linda alluded to, and everybody was trying to shore up their existing portfolio companies. You know, one of the things that I do at ASA is fundraising, and part of that involves talking to investors on a regular basis. And I haven't seen any decline in the interest or any sort of change in appetite in terms of investing or having conversations or talking about particular deals. And certainly the colleagues and the customers that we've talked to, you know, there's been quite a bit of activity. So I would say certainly on the equity side, the equity investments, as everybody else has alluded to, in certain sectors have been very active and have been looking to get involved. I think at this point, in terms of where we're at in the pandemic, if you've made it through that sort of initial lockdown, most companies are in a pretty good position and investors are looking to deploy money.
You haven't seen anyone who says, well, I don't need money, no matter what the situation really is. Everyone, Linda, isn't it? So have you seen any source of fund on the funding, or anyone says, I don't need money?
Not many. I'm struggling to think of anyone, you know, who has been through the last few months and hasn't had difficulty, you know, collecting from customers, or, you know, found a bank line, you know, reduced a bit. So in light of the interest in continuing to grow and to, you know, lean into the situation and take advantage of the opportunities, certainly the need for capital is truly there. Looks like I might have frozen.
Yeah, to add to what Linda was saying, you know, I have colleagues, other people that run businesses or CFOs and things like that, and really they're in the same position where if any credit line that they've had, they've existed to tap, they've existed to take money from investors, and tried to sort of fight for some of the, you know, the particular terms that they'd want to get. So I think that at this point in the cycle, you know, unlike other recessions where, you know, there was a slowdown and it was, you know, it was structurally based, certainly back, you know, in 2008, 2009. The difference this time is that it's highly dependent on the specific industry, the specific company, and we know exactly what caused the slowdown. You know, in this case, it's been very different because people have been able to sort of thrive and continue to work in certain sectors. And it from my point of view, it really is that once people sort of figured out how to do video calls, things have carried on just as they would be. We haven't seen a slowdown like you've seen in previous cycles.
Yeah.
Well, given go ahead, Suresh.
Come back in.
Yeah, no, so I was just gonna, oh, sorry, yeah. Go ahead, Linda.
Thank you.
Boason, are you back?
Yes, thank you very much. My apologies, I guess I got a computer glitch over here. Thank you. Please go ahead, Linda.
Sure. We were still, I think, responding to your question about whether anyone was refusing money at this moment. And, you know, I'll say, you know, just repeat, not too many. Going back to one of the earlier topics, it will be interesting to see, you know, what continues to happen, not only with the effects of the pandemic and, you know, whether, you know, second round shutdowns will be necessary in certain parts of the world and what impacts that might have. But, you know, Suresh was mentioning that the longer, you know, underwriting times of the DFIs, you know, mean that we haven't really seen the full, you know, impacts of the money that has been committed, you know, but hasn't yet made it through the cycles to get to the, you know, ultimate borrowers. The due diligence fee, the virtual due diligence processes in our shop have worked out extremely well. I think we've been through 3 or 4, 1 to 2 week, you know, full due diligence processes with IFC, with a whole group of lenders who are lined up to invest in a geothermal project in Ethiopia. We've been through virtual due diligence as well on a mining fund that's supported by DFC. And so that the virtual platform, you know, offered by Zoom or WebEx or, you know, other entities really in some ways works out quite well because you don't run into the normal, you know, travel complications of people moving from, you know, all parts of the world to, you know, one place to, you know, conduct a due diligence trip. There are certainly downsides. I will say, you know, that there's nothing like having a face-to-face meeting, but we have been able to transition onto, you know, an online platform to be able to keep the transactions moving through the underwriting process. The pandemic and the effects of the pandemic are definitely a topic in due diligence for, you know, all of these transactions. You know, so there's a lot of discussion amongst lender groups to understand what, you know, what might continue to, you know, impact their, you know, future borrower as, you know, we see our way through this.
So in terms of how long you think this the current mood to last, what do you think, Adam?
Sorry, Boason, the last part of the question was how long do I think that this lasts?
The current mood, yes, that's the question.
If you would have asked me this question 3 months ago, I would have thought we would have been done by the end of the year. And I think that this is going to have an impact much longer than we all think. I think that people are getting better and better at figuring out hybrid solutions to things. So to Linda's point, I think the idea of in-person due diligence is going to move to say, we need one person in-person meeting and the rest of it we can do over Zoom, or there needs to be, you know, fewer actual meetings in person as opposed to previously where you would start a relationship with an investor and you might have coffee and you might have dinner and you might have a meeting in their office and you might have 6 or 7 in-person meetings to develop a relationship. That's gonna, I think, go to 1, maybe 2. And then a lot of things are gonna be done remotely, and really we're gonna see only travel related to specific on-site due diligence for physical due diligence. So if you are building infrastructure, or you are, you know, you do have a factory or something like that, where there's physical due diligence done, that's going to move. I mean, what I'm curious is that I think most of the investors that we speak to and within my network, they all raised funds last year and they have capital to deploy. So they're sitting with a lot of quote unquote dry powder, able to invest. Now, when we get a year, you know, when we get into next year, into 2021, and all those funds have been deployed, you know, I think that we're going to see some drying up of things. And I think we're going to see a point where it's going to be, you know, there's going to be a limited number of companies that are going to get funded, but there will be a lot of funding available for those companies. It's just that it's going to, the pool will be smaller in terms of the companies that have made it through then.
But is it possible to raise funds without being on the ground physically? Can this be done remotely, Suresh?
So as a private company, like, is that the question? Will lenders, you know, lend to private companies without being on the ground? Yeah, yes. I think yes. I think there, you know, as kind of Adam alluded to, there is some challenges with this. I think from an execution standpoint, yeah, absolutely. I think investors are getting used to virtual due diligence. I think there is, as Linda and Adam alluded to, there is something lost in that process without being on the ground. I think having a face-to-face meeting at least once is kind of almost irreplaceable. We are replacing it now, but also just having a due diligence trip where you're spending, you know, a day or two with the company. I think there's a lot more casual interaction where you can really pick up a lot about what the operating environment is of the company and the leadership team of the company. That said, you know, all the investors are adjusting to the current circumstances. If you want to invest, you have to be able to adapt. That said, I think really what the issue becomes is, how do you source that as a company, right? If you're not actually able to meet someone for the first time, how do you develop that relationship? So I think that's a little bit more challenging. And I do think there is this general overall flight to quality, which is kind of typical of any kind of credit event. And this is a health event, but it's turned into a credit event. So you are seeing kind of the best, you know, positioned companies, you know, get more traction from whatever capital is out there. And those other ones who are kind of on the edges there are having a little harder time, you know, getting interest from lenders specifically. Doesn't say it can't be done, but I think there's extra kind of relationship building that has to be done, and that's harder in a purely remote environment.
Yes, Linda, is it possible to do lending without this relationship?
I mean, I agree with what Suresh and Adam have said. You know, it's hard based on our, you know, historic mindset about it. You know, there's a lot of things. I was a credit auditor in the very beginning of my career. So I have a built-in bias to getting on the ground and, you know, seeing, you know, literally, you know, lifting the hood on the car to see what's going on. Because there's a lot of things that you pick up just from, you know, being in that environment, you know, seeing how people interact with one another, you know, that you don't necessarily pick up on a Zoom call. You know, things normal is still yet, for the future is still yet to be defined. I don't think we're going back ever to, you know, what things were like in December, you know, 2019 in terms of the way due diligence was done or underwriting was done. You know, so I think we're going to need to continue being creative and resilient and innovative in, you know, how we continue to do business, particularly in emerging markets.
One important, hold on a second, Linda. One of the most important issue for Africa relates to female founders, organizations that need financing but are founded by female. Is there a risk bias here, funding bias for African women who are female founders of their businesses?
So I will say that there's a continued need to focus on supporting women-owned and women-run businesses. You know, I think there are many, many companies that you know, are earlier stage and, you know, need to receive the capital that's been committed, because even though that capital's been, you know, put out, you know, there's been a lot of headlines, you know, from the large DFIs and ECAs about wanting to create flows of capital. There's still, you know, a chasm that exists between that capital and the people who ultimately need it, particularly when you start talking about SMEs. And women-run SMEs have a lot of, you know, further gap to close. There are built-in, you know, biases. I think that people around the world are starting to focus more on those and, you know, try to address those in, you know, very helpful ways. But you know, there's so much more to be done. And I just hope that some of this capital that's being committed to financial institutions by the DFIs as a way to quickly get money into the markets. Suresh mentioned a couple of minutes ago that there weren't a lot of DFIs who had gone all the way through their cycle, you know, taking a new deal, closing it, you know, in the 4 to 6 months that we've had in the pandemic or longer. Actually, there are a couple. We have a very close relationship with FinDev of Canada, which is a relatively new DFI. They have actually closed a couple of deals in less than 2 months over the course of the pandemic, mostly providing capital into the financial sector, because those borrowers are typically easier to evaluate, right? They're typically more accustomed to having, very good financial statements, and the business is easier to understand than a lot of other businesses. What we really need to see is the capital that's now sitting in those financial institutions, as commitments from the large DFIs, that they really put that money out the door, that the DFIs, continue the leadership to encourage and to direct the capital out into the marketplace, not just to sit inside of the financial institution, which we have seen happen, many times in the past. If you are able to borrow at a very low rate and invest in government securities and make a spread, and somebody's telling you that that's not against the rules for the money that you've received, then you might do it. You might just continue to make that known spread. So, I do think that it's important for, business leaders and and governments and leaders in these DFI institutions to continue to press for that money to go, to the SMEs, and particularly the SMEs that are led by women, because we have a lot of work to do to get to parity.
I agree with you. It's a long road to parity. Let me ask Suresh from his experience in Kenya, for example. We've seen the World Bank promising $2 billion to small and medium enterprises, direct funding in Kenya, for example, to businesses and individuals. And then the Kenyan authorities have also talked about several billions of shillings for SMEs as well. How much of this do you think funding will go to women-led enterprises in businesses in Kenya, for example?
It's a great question. It's a great question. I really don't have an answer. So what I don't know specifically is that they put a priority on it. I'm making sure, a material portion of that funding goes towards the women-owned, women-led businesses. I also, I think these programs are often designed one way and then implemented another. So I think there's a matter of how the implementation rolls out. Is it, really widely accessible to the business community? Is it well dispersed? Is it targeted correctly? I think these are all questions that kind of any funder, whether these programs specifically or otherwise, need to be focused on. So I think it's a very relevant question. I will say in Kenya, there is, we tend to work with, younger companies, and in Kenya particularly, there's this great startup ecosystem, and there is a pretty strong, women-led component of that in Kenya. So I'm hopeful, but that said, it all comes down to execution, and I can't say how that's gone so far.
Adam, what would you like to see change? What would you like to see get done along this conversation around female founders, African businesses?
Yeah, well, many of you may know that as it was founded by Elizabeth Rossiello, who, and I've worked with her fundraising, and I've worked with, in other companies with other male CEOs in other contexts. And the unfortunate reality is that, the questions that are asked, and I think that some of the things that are posed to women CEOs, unfortunately, are not the same as men. And, not every investor is the same. So I'm not going to, not everybody's cut from the same cloth. But there are harder things, and I think that there's certainly challenges that women CEOs face that their male counterparts don't face in terms of fundraising, and it would be great. And I don't think this is specific to Africa or to any actually particular geography, but it would be great to see us move more towards, as Linda said, parity in terms of the expectations or the perceived risks or the conversations that people have around, particularly gender-oriented CEOs. So yeah, I think things are getting better, but we still have a long way to go.
Thank you so much, Linda, Suresh, and Adam. Let's take a few questions in chat from our participants, and they're coming through. By the way, I'm going to start with Mabonga Robert, who is as a pastor of a church in Uganda, and he's asking if there is any organization which can come to help the church, if they can come up with a project proposal, because he says we do have people whose heads of family are in the quarantine, leaving children at home without help, and such families are ending up coming to church leaders' home looking for help. Is there anything here? Suresh, I'm going to direct this to you. You have a bit more of a footprint, boots on the ground on the continent.
So it's a hard question.
There's a project proposal. Is a project proposal, will it be done on the basis because it's a church, or is it going to be funded based on the fact that this is a bankable project proposal that can be funded? Are there risks and all of that?
Yeah. So with from a lendable perspective, and the mandate we are given by our investors is to ensure that projects are bankable, right? And that we are confident we're going to get repaid, and we're going to get repaid with a return. So financing a new project, unfortunately, is not something we can do. That said, there are a number of institutions, both kind of locally, regionally, and globally, who do provide this type of funding, whether it's grant, whether it's kind of early stage equity financing. It really depends on what the proposal is. There's the likes of the development agencies like USAID, or the UK's equivalent. There's local and regional institutions in Uganda and East Africa. That said, there may also just be seed funding if this is a business endeavor. That said, from a Lendable perspective, it's out of our mandate as an investor and what the remit we have from for our capital providers.
Linda, any thoughts on this? Will there be any funding bias?
I agree. It's a difficult one. Most of the capital that we work with is, although it's provided by governments through bilateral and multilateral agencies and platforms that they've established. Most of this money they expect to be paid back, and so the idea is that there's not much money that is available, in the form of a true grant or something like that. There are an increasing number of technical assistance programs, out there to help bridge from a startup stage into a true operating business platform. But in terms, so I would say to the pastor that I would probably see if he could help his church members to to see if there are ways that the businesses that they're trying to pursue might be able to get support through microfinance institutions or places like that, so that they could help their businesses get off the ground and help the trickle through into the economy in that way.
Thank you so much, Linda, for taking up that as well and fleshing it up. By the way, Adam, we have one of our participants who are also asking a question. Is a Pascal from Ghana, and the question is in respect of a startup funding for commodities, cocoa, for example. Is there any money available in the absence of any financial and operational history? Of course, Ghana is rich as far as cocoa is concerned. So this is an unexpected question, by the way. Is it that cocoa or gold, by the way?
Yeah, I think for startup funding and for initial capital, I think that from what we've seen and what I've looked at in terms of deal book and heard through some of the startup ecosystems, is that a lot of the accelerator programs, a lot of the programs that are designed to bootstrap businesses from the very start that have no operating history, they're still going on and they're still accepting applicants, and they're continuing, and they're still cutting small checks and taking people through these accelerated programs, and sort of going through that same program that they went through last year prior to COVID. And so those are always an avenue for initial businesses, and I think that that's a great way that they're still going on. And I know that that Ghana too has a bit of a startup ecosystem, and that there are some of these programs that are focused out of Ghana, or at least out of Accra. And the other thing is, you know, I think certainly in this time, and certainly with no operating history, the family members, rich friends, cousins, anybody like that, you really got to go out and find money from, because there is certainly a jump, irrespective of COVID, from going from that initial operating history of zero to actually getting an investor in, and then there's certainly a bit of a jump to actually public capital, or even VC capital. So I would pursue the accelerator route. The
accelerator route. Thank you. We have perhaps this question from a group of folks in Nigeria also will fall into your comments, Adam. It says, Fortune Basset says, and a group of young men and women, about 800,000 of them, that's huge, that needs funding through business platform and require a minimum of about 80,000 naira only for each person, and they can pay back within 180 days. And it says it's bankable. Can they access fund as a group? Let me ask Suresh to take that. Suresh, can you speak to
that? Sure. So I think businesses like this, where there is a business model that seems to be developed, but perhaps it isn't proven yet, right? So they don't have a track record, they don't have experience actually implementing this and getting repaid. I think it's absolutely a business that should be, has the opportunity to be taken forward. I guess I would view this as equity risk, though, right? And in developing that track record, there should be equity funding skill behind it. And so, and to what Adam said, this is perhaps where some of these kind of seed stage funding programs come into play to help both capital come in, but also help the business model be refined, right? Because, things generally don't go how they are planned to on paper, right? And so it's helpful to have that supportive environment to feed advice back into the company as they go through this kind of learning and growth phase themselves.
Okay, so will you just speak then to, looks like some of the questions are coming through those who are startups and SMEs. We have another question from one of our participants. It says his name is Jovan, he's the CEO of FLR's B2B consultancy. How can consultancy services benefit from these programs, especially in this lockdown phase where business consultancy for SMEs are not appreciated by this group of business people, whether those who are doing DFIs and whatever? Is there something for consultancy in SMEs? How I got that question correct? Suresh?
Yeah, I suppose this goes a lot to what the consultancy is. So as part of our, mandate and really impact thesis of Lendable, we have an emphasis on supporting the SME community. That said, the way we do that is through intermediaries, right? So we support financial technologies who are serving companies who are serving the SME sector. So generally companies that are either, lending money or facilitating flow of funds between SMEs. And so we do that, but typically with intermediaries, I would say a number of these intermediaries that we work with are, SMEs themselves, but they've been able to go out and develop that track record. In terms of how consultancy relates on that, I think that's just, as I read it, just a pretty broad, term. So it can mean a lot of different things. So I think it really, specifically goes to, if they're helping them raise funds, identifying the appropriate pool of capital that SME is working with, right? So if they're working in the ag space, there's ag focus, capital sources. If they're just early stage, SMEs, there's capital sources focused on those SMEs. There's, from a grant, equity, debt standpoint. So really honing in on what those different capital sources are, because the reality is, Lendable, we serve financial technology and what we think is the wider, fintech community, and we try to drive a pretty broad definition of that. At the end of the day, we have a pretty prescriptive mandate. And so it's hard for us to go outside of that. So it is all about finding the right pool of capital for those SMEs specifically. And that depends a lot on where the SME is and what the business they're in, et cetera.
Oh, great. Thank you for your insight, Suresh. I'm going to ask this question directly, a very short one, to Adam from one of our participants. Kagimu Bosco says, will it be a good idea for someone to start a new business in this time, especially MFI? I guess that's a microfinance institution, I hope.
Yes, I would think it was a great time. And I think that there's always, at the bottom of cycles, there's a lot of great businesses that are started. And if you can make it work and you can actually get through that initial stage, you know, you're not bulletproof, but you know, you've been able to make it through, you know, a global pandemic. So yes, I would absolutely think that this is a good time. Just to go back to the earlier question about Ghana, Nest was the institution I was thinking of. That's a startup accelerator or seed funder that's based out of Ghana and Accra. That could be something that you could look for. But yeah, I think it's a great time to start a business. And I think if it, you know, I'll let the Suresh comment about the lending cycle, but I think that starting a lending business at this point in the cycle might not be a bad idea in terms of as a lot of the defaults sort of move through the system, and you're looking at sort of companies that are now going to be around for a while.
A quick one, Adam. What would we're moving towards the end of the year? So, what would ASA? What do we expect from ASA? Will there be a new curve as you look back into 2020, into New Horizon? We're starting the final quarter of the year tomorrow, 1st of October. So 90 days to the end of the year. Is it time to sit down and do a quick review of the year, or you want to wait until December 31st?
Yeah, I mean, like I said earlier, we've been in a great position to have really accelerated through the pandemic. And, you know, I think everybody's excited to close out 2020 just because it's been such a volatile year, you know, business aside. We're really looking forward to kind of taking this, I think what we think are the positive things that have come out of this, which is, you know, moving more towards a digital channel. We've seen the acceleration of digital payments. We've seen the acceleration of more voice, you know, video conferencing, remote teams and things like that, and take that forward and being able to serve more customers and being able to kind of continue to grow the business, which we're really excited about, you know, closing out what has been a really strong year for the company, but yet a tumultuous year with just the lockdown and changing and things like that, and then just continuing to grow in 2021.
With the digital space expanding more on the African continent, is there a bigger business opportunity, new areas for ASA on the continent?
Yeah, I mean, so one of the growth drivers for ASA is geographic expansion. And so we've been continuing to expand it in new markets. And in the beginning, it was a little bit slow because, you know, some of the institutions, some of the banks, some of our counterparties, they were a little bit slow in terms of doing business when we initially went into the lockdown. But as people, I think, have continued to, you know, learn how to work over video calls and learn how to work from home, we've seen that pick up and accelerate. So we've really just continued the existing expansions that we started either during the expansion or during the pandemic or prior to the pandemic.
Okay, great. It's good to have Linda back. I'm going to ask you, Linda, very quickly. A good time. We understand sometimes it could be very patchy. I'll just ask one last question from one of our participants about whether it's a good time to start a new business, maybe a microfinance bank at this point in time.
I think there is a lot of capital out there, you know, looking to progress the Sustainable Development Goals of the World Bank. And so if you are looking to get into a business that would, you know, help SMEs or align with the SDGs, I do think that there is an incredible amount of capital out there to help. So if we were talking earlier about women-owned and run businesses. So if you, you know, do have an ability to address gender equality concerns, if you are, if you have a Fintech technology, if you know, that goes across, you know, boundaries and borders, if you are, you know, able to, you know, set up something that creates a lot of jobs and training and a lot of impact for your local economy, I definitely think that it's a time to tap into the capital that's available out there.
Sure. Are there sectors specific that you think should attract funding at this point in time moving forward, things that we're seeing on the continent and the need that the continent needs to feed, whether it's in healthcare, in medicines, in pharmaceuticals, in solar energy, in agriculture?
Sorry, it was difficult to hear the first part of the question. Could you just repeat that?
Yes, I was asking if there are sectors specific that you think funding opportunities exist on the continent and that could be explored, when you look at the current change and the virus period, healthcare, Medicare, pharmaceuticals, research, R&D, agriculture, agro-processing, and all that.
Yeah, so let me start speaking specifically around kind of Lendable. We definitely see funding opportunities into the fintech sector. As mentioned before, there has been a shift to digital. Right? People can't necessarily go down to their bank and deposit money. In countries like Kenya, where M-Pesa has already served as a foundation, it's enabled further business to grow on top of that. I think generally we've seen a lot of, multiples of expansion of payment platforms in terms of their transaction flow they're seeing on a daily and a monthly basis during COVID, whether that's internal to a country or across borders. And so we do see kind of a lot of opportunity for the growth of the fintech sector as a whole. This has forced people to become more comfortable with digital, and whether it's digital money or whether it's Zoom calls because everyone's taking digital meetings. I think it's forced everyone to do that, and I don't think we'll turn back on that. I think that will continue on at some enhanced level. Outside of that, and this is a place I don't play any anymore at Lendable, but certainly did when I was at OPIC, now at DFC. I do think there will be continued funding opportunities into the likes of the energy and infrastructure sectors, renewable energy specifically. I think that will be continued mandate, until the continent really, on a country basis, catches up to their needs, right? And their ability to absorb that energy, both from a capacity and also a financial perspective. Be a lot of emphasis from the kind of larger international financing institutions and the private sector on this. I would say the other places we do see kind of a lot of continued interest are on financial services, so making sure just general, whether it's financial technology through fintechs or traditional methods, and the agricultural space. And I think the ag space will, particularly when you're coming through some very hard economic times, will continue to be of emphasis because, these development institutions, know they need to build in the sustainability of an economy and food security into their overall, offerings to these countries. And then, of course, I think one place we hadn't seen a lot of activity previously, but we will now, is in the health sector from an investment standpoint. And everything from kind of health infrastructure investment on down through pharmaceutical distribution, et cetera. I think we see programs around that, but again, I think we'll have to see that play out over time.
Okay, great. I'm going to ask Adam about crypto and blockchain. For example, in Nigeria, the SEC has just opened up a new regulations for regulating crypto and blockchain securities in Nigeria, for example. And do you think there are business opportunities, lending and funding opportunities in this space, for example, in Nigeria and across Africa? We see a very young population, many of them getting into a number of areas using technology to do crypto, to the blockchain, to do forex trading and Coinbase and services like that?
Yeah, so one, we're really excited to see the regulation come out, excited to see that the SEC is going to regulate it. And I think that just further legitimizes it and also further puts it in the eyes, and the mystique of it kind of goes away as soon as it becomes regulated. So we're really excited to see that. And we think it's great that Nigeria was progressive and did that quickly. So excited to see that will accelerate it. And I think that further supports this move towards digital, whether certainly with crypto, it could be in the payment space or, a variety of spaces with other sort of blockchain technologies. And Nigeria has actually been a really good market in terms of, and startups in terms of interest and things like that with crypto and blockchain. So we're really excited specifically with the regulation and kind of moving that forward. I do think that we are going to move, and there's going to be further and further research and development and interest and startups in terms of digital payments with blockchain or some sort of crypto backed architecture and infrastructure. to Suresh's point about mobile money and things like that, crypto still, it's not quite there in terms of, the popularity. It's not quite as usable as, say, M-Pesa in Kenya. So there's still a little bit of ways to go, but we're excited about the trajectory that it's on. And we think that it's going to be much, much easier for anyone from an SME to a government to be able to kind of work with and now understand it under the regulation.
My final question to three of you, my panelists, is around the new intra-Africa trade AFCFTA, scheduled to begin 1st of January next year. Do you think, Linda, and I'm going to start with you, in terms of what funding opportunities do you think this new intra-Africa trade will open up a whole new chapter for funding opportunities, lending activities on the continent? And what do you think is the time to position for developments within this? We're just around 90 days to that takeoff point.
Linda, I think you're on mute.
Linda, thank you. Okay.
Okay, I'm back. Sorry about that. I'm not sure how that happened. So to answer your question, Boason, I hope so. There really cannot be enough, capital flowing into the emerging markets, across the spectrum of, potential recipients, from the micro companies, all the way up to the, largest financial institutions. Because, honestly, we're all going to have to work together and show collaborative leadership to make sure that the capital goes into, fill in the soft spaces that have been created by the pandemic and, really, help all, so that all of us, work together to get through the recovery.
Sure. You can hear me?
Yeah, there's.
Thank you. Just to ask about if there is anything that can come through the various stimulus by the central banks. That's my final question to you in terms of if this will be of any help.
Yeah, I think stimuluses through central banks have proven to be very effective, right? As they've been directly implemented by various central banks around the world. I think we've seen that if this can be very direct to the most impacted of the populations and businesses, it's been helpful to sustain something that has been a fairly long-winded impact on businesses. So, these lockdowns have effectively crushed the ability of many businesses to make revenues at all, which has a direct impact on their ability to employ others. So to the extent that central banks are capable of providing enhanced funds into the marketplace on a direct basis, I think it's helpful. But I do think implementation has proven to be difficult for many to do this very directly, so the impact is felt the strongest. We've also seen from a debt forgiveness standpoint, we've seen a number of moratoriums on debt repayments around the world, which has been useful. But I think the longer those are kind of put out there, I think it's going to make it difficult for businesses to raise money, quite frankly, because as an investor, as a lender, if you're fearful of the next moratorium and how long that's going to last, or if there's going to be another one next year, it's really hard to put money into the country. So I think it needs to be very thoughtful implementations. Understanding at the beginning, everyone was just putting policies into practice because you had to be very reactive. There's been time now to really think about these things and what's the most useful way of rolling out these programs.
Boason, you're on mute.
You talk about rapid fire stimulus going on around. What does that mean? Adam?
Sorry, Boason, you're on mute. I didn't catch the first part.
Okay, my question was, there's a stimulus by central banks. I said there's a whole lot of rapid fire trying to stop, as it were. I was asking if this is, Suresh talked about if you put loans into moratorium, then you're not too sure whether the next payment to be made. For example, look at Zambia or Angola, say, look, we're not going to pay until the next April. Then they said, okay, next April, we'll move to the next April.
You broke up a little bit, so I don't think I got the full question. What I think you asked is that with the government-backed funding and the rapid fire funding, is that going to have an impact on where people do business?
Yes, and if this will be a major or risk factor for lending.
A risk factor for lending.
Yes.
You know, I don't have a ton of experience with some of the government-backed programs, and I've read some of the stories in the headlines in terms of some of the debt forgiveness programs that they've done. You know, and again, I'm not a lender, so I'm not sure if I can answer the question about risk appetite in different countries. I can say from my perspective and as a company's perspective and the CFO's perspective, you know, these are all these programs that the governments are putting in place are great, and they're trying to shore up business. You know, ultimately, if you're trying to start or grow a new business, you know, those that are put in place are really not designed to be growth capital for businesses. So those particular programs aren't really going to affect kind of where we would think about expanding or where we might think about trying to tap lenders and things like that. But, you know, maybe I'll let Suresh or Linda comment more on the appetite towards or how those affect the particular appetite or risk appetite of geographies.
Suresh, you want to give us just about 30 seconds on that so that we can wrap it up?
Sure. I would say one place that would be very helpful is, quite frankly, in a country like Nigeria, where we've seen a lot of difficulty getting US dollars out of the country. So this is a place that the central bank has a direct capacity to, you know, ensure liquidity in the markets, which gives lenders and investors generally comfort, right? And so that's one example of how this could apply to others around the world. To just give, you know, this is not a normal operating environment, but the closer we can bridge back to that, the more comfort it will be, and that will, you know, increase the risk appetite, or not, perhaps not increase the risk appetite, but increase the lender's ability to understand, underwrite, and execute on that risk.
Thank you so much, all of you. Suresh Samuel, Investment Director at Lendable. Thank you so much for your time today. Linda Habgood, CEO of Delphos International. Thank you so much. And Adam Gouveia, the Chief Financial Officer at AZA. Thank you for everything we put together. Thank you, the AZA team, for your analysis and the organization of today's seminar. Thank you so much, everyone. We discussed many issues relating to funding in Africa. AZA is committed to supplying liquidity, connectivity, and treasury solutions to support growth in transactions in and across Africa through its BFX product. You want to learn more about that? Go to tradebfx.com. You can see the details of how that works. Thank you so much. We'll be posting highlights from today's webinar on Twitter. Go to AZA_Africa and do interact with us there. Thank you so much, everyone, and we appreciate your time. Have a great day, and I will see you next time. Thank you, Suresh. Thank you, Adam.
Thanks, everybody. Thanks, Linda. Thank you very much.
Take care.
Thank you very much.